Well, hello. I'm here with Roy March, my good friend, Chairman CEO of Eastdil Secured, and great to see you today, Roy. How are you?
I'm excellent, thank you. Good to see you. Hope you're well.
Very well, thank you. You and your family?
Yeah, all good. All very good. We're very fortunate, very
Well,
blessed.
what does the view of the ocean look like today?
Oh, no, no, no. You're not going to trap me with that. I'm here, in that corporate wrapper. I don't want anybody to feel bad about how good things are here.
Exactly. Well, I do see that you have Eastdil Secured background behind you, so
Yeah,
I
yeah,
commend you on that. Support the
yeah,
brand 24/7. Well done, my
yeah,
friend.
yeah. Thank you. Thank you.
Super. Well, seriously, where do we find you? How are you doing? How is life right now in this crazy environment?
Well, I go through waves of emotions, and I think and in leading a company, I think it's important for us to understand that the people who we work with also go through these waves, and they're different generations at the end of the day as well, oftentimes in isolations, not in their hometowns. And so I think it's fair to have not fair but appropriate to have the empathy for how they feel, and to share how you feel and not be afraid of that. The truth is, I wake up with high anxiety in the morning, anxious to make sure that everybody is well taken care of, both from a health and well-being perspective, and both physical health and emotional and mental health. I think it's super important, and this is something that we always thought of as part of our culture, but I think we've re-emphasized as a result of all this. And then I start the calls, right, and try to get to the source of information. Try to take the, if you will, the advice that we give clients as a trusted advisor, which is to assess what your exposure is, try to mitigate your exposure, and then do the things that you need to do ultimately, and then look forward as to what kind of opportunities are created as a result. So that's kind of my day, if you will, and that's what we advise, and it's what we advise ourselves. And the other part of it is just trying to keep kind of healthy in all this period of time. I've as you may know, I've got a couple of challenges. I've got a push-up challenge going, I've got a plank challenge going, and I've got a walking challenge going with 3 different constituencies of clients and partners. And so those are the things that we're doing to try and stay healthy and to stay sane as best
Good.
we can.
Whatever you're doing, keep doing it because you look
Yeah.
terrific.
Oh, well, thank you very much. Appreciate it. I'm actually at my college weight.
Yeah, really.
Yeah.
That's impressive.
Yeah.
Roy, when I grow up, I want to be you.
Oh, yeah, 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 yeah.
That's amazing. All right, so let's jump in. Um, Came March, and I'm sure the music, if not stopped, it changed a lot. So what happened briefly, and what is the status of Eastdil Secured
Yeah.
today as far as relationships with client and
Yeah.
activities?
Yeah. Well, interestingly enough, not unlike the rest of the industry, we had a very robust first quarter underway. January, February, and the beginning of March, we were looking at year-over-year growth in the low double digits. And then March 13th, Friday, March 13th was kind of the day that I'll remember, which is I was standing there with a group of people looking at a press conference by the president and saying to everyone, remember this day. And I didn't realize how prophetic that might be, because at the time we were then looking at a phasing of our workforce in flights, if you will, a platinum and a blue flight, A, B flight, if you will, around the world, to be able to implement, correct social distancing, if you will. And things did come to, and we went from that to the stay-at-home orders that were thrown around a blanket around the entire world, as it turns out. And things did come to a screeching halt. And I describe it as kind of a fog of war, where no one really understood exactly where the world was potentially going. And so it put a freeze. It paralyzed people, both intellectually and physically and emotionally. And that shock to the system has taken a while to begin to unwind. But for us, it was really trying to secure on behalf of our clients an understanding of where their exposure was as a result of basically the shutdown of liquidity in the financial impactful demand drivers, like being able to occupy space, being able to go to restaurants and all those kinds of things, being able to shop in person. Might have as an impact on the demand side and the daisy chain of events that sets off in terms of rent payment, in terms of mortgage payments, and ultimately bond payments and the like. So our goal was to get across the line virtually everything we could. And so in those early weeks, we talked about pre-COVID and COVID, if you will. And it's become kind of a state of discussion, if you will. And from that point, it was really getting across the line things that were committed, things that had hard money deposits, had commitment fees funded. And by and large, most of that occurred without hitch. There were a couple deals where they were either transitional or in the hospitality space in particular, where there were hard money deposits, where it looked like, candidly, the value diminution was much greater than the deposits that were up. So it was triage, to be sure. And at the same time, as I described to you, we were going through a technology transition. And so we went remote overnight with 2 systems simultaneously. And thankfully, our technology team was just extraordinary around it. And we got everybody remote in 48 hours. Around the world, from Singapore, Japan, Hong Kong, Seoul, and Dubai, Paris, Germany, London, Dublin, and then all of the offices here in the US. But literally in 48 hours, we were remote and operating day one, Monday morning, as a team, and connected as one unit, one culture, one team, if you will, on behalf of our clients. And then it was, okay, where do we go from here? And we went into that, that triage, as I suggested. And what we've seen is this kind of separation or barbell, and there's the distress, and then there's the opportunity. And there are people who see opportunity in distress, and then it's trying to see what it looks like over the horizon coming out of this.
So what are you working on right now? What are your clients asking you to do for them, and what are you advising them to actually do? I understand assess the situation, protect your situation, but let's talk more about more offensive or more proactive.
Yeah, well, the first wave of this was liquidity issues, and those issues were showing up first in the mortgage REITs, particularly those that were, in essence, had margin calls. Yep. And literally they were scrambling for liquidity to survive. And so those were the first orders of business, because that was the first wave, and it was prior to the government stepping in with the massive liquidity that they put in place to try to assess that.
From all that I've heard, Roy, and I'm curious if you have different data or experience, that was a very small window in time, and there was very little of activity. There was some activity, but it was not really a mass movement of capital into that space that the Feds kind of got in quickly and plugged the hole. Am I right about that, or
they didn't plug the hole? What they did was they provided liquidity across the overall system, and that liquidity washed through those areas first and foremost where they were buying, in essence, and providing that liquidity, and then it washed over into our space. But even weeks later, when they approved real estate, if you will, AAAs in the TALF program, those were for short-term AAAs, and they really didn't impact the real estate finance industry very much.
Right.
What happened though was that, in particular, the first wave of impact was these debt funds and these mortgage REITs were a substantial portion of the financing market, and as those were shut down, literally in crisis mode, There were people moving into that space, buying, loans, providing liquidity instruments and the like. And then the next wave of it was the banks being hit with, candidly, forbearance requests. And so much of these large banks, the big banks in particular, took their origination teams off the field and put them into asset management, trying to assess, kind of what their exposure was and what their borrowers' exposure was. And so much of that now was waiting for the 1st of March, the 1st of April, to see what the payments were going to be, whether it was, retail, what the shutdown of these hotels meant in terms of operating costs while shut, in terms of office, which tenants were going to pay, not pay, and the same thing with multifamily and across the board. So it immediately went from a liquidity issue to now a demand issue in terms of who was going to pay rent and who wasn't going to pay rent. And that dynamic happened very, very quickly, literally within that 2-week period of time. So it was substantial, and it paralyzed really the financing market for that.
And now, where are we now with respect to liquidity?
The fog is lifting, but it's still dense. And so what we're seeing is very little activity, if any, in the debt fund. Activity in the bank space, other than again forbearance requests and and covenant modifications and things like that. The life companies have been remarkably reactive to this, and they've continued to stay in business, but they've been overwhelmed. And then at the very end of the day, what happened was there was liquidity challenges throughout the system. So we were no longer dealing with the head of real estate at an insurance company. We were dealing with the CIO, who was trying to make decisions about how to distribute their liquidity around the entire universe, if you will, of financial instruments. And so that was, again, a little bit more of a challenge. That's beginning to clear a bit right now. And so we are actually getting financings done. We closed a deal actually in downtown Los Angeles that was a large office building, multi-tenant, 45% LTV in the middle of all that. There were some adjustments relative to interest reserves and things like that that ultimately came to be. And then the question was, okay, what do they do with it? Because it was ultimately originated to become a securitized product that would be distributed. And just last week, it actually went through the securitization, and we got some visibility around what you could price something like that at. But spreads blew out, but realistically, nobody was transacting. Yeah, spreads blew out. They came back in. Interest rates, nominal interest rates blew out from, call it, the high 2s on a 10-year fixed rate to low to mid 4s if it was available, and has come back into kind of that 3 to 3.25 range, and is trending towards the 3 from 3.25, depending on the deal, on a 10-year fixed rate, and I use that as a bellwether against kind of real estate returns.
So you describe interest reserves and things like that as some of the new bells and whistles on lending product. Yeah. What about the loan amounts? Has the underwriting changed so that same assets will generate fewer proceeds today, or are we back to more or less same underwriting?
No, so the underwriting's changed the most, Gadi. And again, as I described the barbell, you've got those that do not have long-term contracts associated with them, or no foot traffic to generate sales to ultimately generate the ability to pay rent. So you have kind of that end, and then you have the other end, which are contracts that are in place, and they could be as little as 12 months in the case of a multifamily, to 5 years. Logistics rents that could be 5 to 7 years. And so everybody is waiting and kind of watching as to what this payment schedule is going to be. And it was remarkably higher than people thought it was going to be. But the question still remains, what will that look like when we come back to work, if you will? and kind of come back to the new normal, if you will. And from that perspective, our sense of where the market is today is the cost of capital, the nominal cost of capital, an IRR return, if you will, over a 10-year period of time. We don't think that changes much. We don't think that ultimately people are underwriting to a higher cap rate on the back end versus lower cap rate on the back end because of all this quantitative easing that's occurred. Lower for longer, which we've been talking about, will be lower for much longer, we think. And but what is changing is the underwriting. And so those assets that have good, weighted average lease terms, those probably are going to have the least amount of impairment around valuation. And obviously those that have a shorter term lease duration will potentially have the most. And that's, in that analysis, if you will, the kind of value add space where you've either got a lease up or a rollover situation as opposed to a core with a longer weighted average lease term. Those are where the impairment's going to be likely the most, but not because the cost of capital has necessarily gone up, but because the underwriting will change to reflect people's view as to how the new normal will be viewed. Does that make any sense?
It totally does. What you're saying is that because of, although the return expectations haven't changed, people want to have more safety around those returns. So
correct.
They're putting into the modeling and into the pricing a more conservative set of assumptions on rent renewals and rent rates and occupancy levels going forward, all of which is driving the nominal value, although it's not a pricing mechanism, the nominal value of the asset. And off of that, they will land 70, 80% so long as all the other. Got it.
Correct.
It does make sense.
Well, nobody's landing 70, 80%.
Fair enough.
And that
40,
is the
45,
other thing.
50%.
Yeah, that is the other thing. And going into this, we did see that leverage levels were not as high as they were back in the GFC days, where we'd stretched into the 70s, if you will. We were in the low 60s going into this relative to that, and we also were in a lower base rate environment going into this than we were. But leverage levels weren't quite as high. They were, again, probably 12 points inside of where they had been during the. But that doesn't mean that leverage wasn't beginning to creep up. But for sure, people are, in essence, lending at virtually the same rate, but for 5 points inside of where they would have lent it at, 5 to 10 points inside of what they'd have lent it at pre-COVID.
On the LTV basis, you mean?
Correct.
Yeah, gotcha. Yeah. So, thank you for describing what's happening out there. What about transactions? You talked about the debt market. What about the capital markets for equity and the movement of assets?
Well, you know how these screens sometimes when you're using this kind of freeze up? That's what it feels like. And we're waiting for spring, if not summer. But if you look at it, again, we were up low double digits as an industry in institutional transactions. And a lot of that was driven candidly by logistics at the end of the day. And the impact, candidly, of e-commerce and all that, which I'm sure we'll get to here in a minute in terms of the winners and potentially the ones that will be more challenged, if you will, longer term. But it dropped in March about 25% month, March 2020 to March 2019, off of what, but the quarter, because of how strong it was, going into it, was up, as I say, just about 10.5, 11%. That's fallen off in April by 75%. In terms of equity transactions. And I think that that's a fair assessment around the debt markets as well. And everything is being done by appointment. We talk about curation. This is really, like trying to get into the best doctor or dentist out. Everything is being done absolutely by appointment at this point in time. There's no more marketing in the more traditional ways.
I would expect, Roy, that most of the stuff that has closed in April were pre-COVID deals that actually a seller and a buyer decided not to get out for whatever, or were managed to negotiate. I would assume, but you can help me understand whether there are new transactions that are actually getting out to the market and get interest in them. I suspect if there's any place where you can see that would be into data centers, maybe industrial warehousing. In other asset classes, I suspect not, but I wonder what are you seeing out there?
So we're seeing, and it's interesting, and we'll talk perhaps about this a little bit because of what we saw, kind of how things returned in Asia, how Europe has reacted to all this, having gotten into it, weeks, if not a month before we did, and then kind of where we are. It's been a shift, and as I said, the kind of future. And the future is clearly around logistics, particularly anything related to e-commerce. Amazon has leased in the last 6 weeks 40 million square feet. That was unexpected. They're not the only ones. Walmart, if you talk to any of the grocers, they've had the biggest quarters, biggest months, biggest days in their entire history. Supply chain issues will and inventory hold requirements by some of the major retailers that utilize distribution as part of what they do. Those also will have an impact structurally on what's going on in logistics. But logistics is a huge, huge, huge beneficiary of all this. And there are some cracks in what I'll call some of the smaller spaces and formats where they may have been a little bit more dependent on gambling, for example, or hotel distribution or retail distribution, but otherwise a strong demand. We actually expect that pricing will go up in logistics going forward. So if you look at my commentary around demand and cost of capital, so if cost of capital stays about the same, but demand goes up in an area, we're likely to see more value accretion in logistics and industrial. Yeah. The other big winner is life science, and while it really was thought of as a niche back in through 2014-15, huge winner coming out of this. A lot of people had begun to shift from being a core office investor, and while allocations had gotten to their maximums, and give them advice around those kinds of things. They were beginning to get into life science more deeply. That space, if it had gone from a niche to a fad to a trend, is a legitimate industry segment today. Mm-hmm. These are not necessary, and not all the credit can be underwritten specifically. But if you understand what the mission critical nature is of some of this stuff, and you understand what the use is of the space and how that has changed over the years, you can see a big bid. One of the things I think about is if you think of the fact that $29 billion a year was being sunk into this through NIH grants and things like that, and that was creating demand, and that was the high point. And you look at the CARES Act, which has $120 billion allocated to hospitals and these kinds of things. And you think about the fact that we're going to issue $4 trillion, potentially $4 trillion worth of. What kind of investment is going to go into it to prevent something like this from happening again? Whether it's stockpiling of supplies because of some of the things that we've seen with our inability to be able to get to those things early enough, and that's that impact. Whether it's specialization hospitals, whether it's ultimately prevention and cures, treatments, and the like. You just got to imagine that that's going to be a huge tailwind behind that space. And then we've always talked about these innovation markets having outsized dynamic and sustainable growth. We think that that's going to continue, and the technology will continue to drive this innovation, adjacencies, collaboration, and the like. Those markets will continue, and those again, you're going to have to understand the credit of these leases. And everybody understands where Amazon is, but XYZ may not be as understandable. But I think that those are going to be big winners as well, because they're going to be credit. They're going to be, what I'll call mission critical to whatever is going on in the world. And then in the multi-space, I think you're going to find that things that have the amenity package that kind of, speaks to a work from home environment and or the ability to at least have that flexibility. On the multi-side, we see a lot of great things. And then you've got the data centers, which you pointed out. That's a little bit more technical, and you really have to, in our view, have super expertise around it because, leapfrog technology and the like, you don't know, what that power shell is going to look like going forward. So you really need expertise around it. And my guess is that what comes out of all this is something in the healthcare space beyond life science, whether it's skilled nursing and or some of these things that are big problems today. There's going to be innovation in that space, and it's going to ultimately, I think, be someplace where that'll go. We've talked, as you know, around the ESG aspects of what's important to limited partners and investor sponsors, and ESG has become an increasing element of all that. All of these things will speak to that, and so this is, it's not a coincidence, probably. Maybe it's a plan, but at the end of the day, we'll see. But those are the areas that we think are going to be the most robust, and don't see pricing, coming back. Don't see pricing challenges with those kinds of things because there's going to be, on the demand side, huge demand. So where does that leave you? That leaves you in the value add space, and I think you got to be really, really, really specific, or trying to underwrite, re-tenanting, and being much more specific, less generic about demand drivers in a given market that will ultimately be there.
Yeah.
And I think that you're going to ask me a question at some point about what the future leads, and I'll wait for that one. But I think it's going to be all the more important.
Yeah, that was a great overview of a lot of trends that and the changes that are coming up. One thing I wanted to talk to you a little bit about, you touched upon it, so maybe you can dig a little deeper, is what patterns that maybe have begun before COVID-19 are going to be accelerated by what we're going through. And you talked about supply chain collapsing, you talked about life sciences getting more funding, you talked about warehousing requirement for stockpiling, et cetera, accumulating. So perhaps going a little bit beyond that, and maybe you want to focus on the e-commerce and impact on retail and brick and mortar, other things like that, where you see investor appetite moving in new directions that may affect where transactions will end up being.
Well, this given your background and history, this will probably resonate quite nicely with you, Gadi. And I promise you didn't tell me to speak to this, but bottom line is, I think being a more intelligent investor, okay, and that means data. And data and information will be critical, and it's becoming more transparent and ubiquitous as it relates to how to do it. And it's not just about being able to create AI and machine learning and everything else. It's taking direct data, and that's part of what we're trying to do and bring to our clients is information to make judgments, to create either thematic and or specific targeted investments, not just in real estate, but within real estate where you do have these robust and dynamic demand drivers that ultimately give you the kinds of returns that real estate's supposed to give you in an overall portfolio. And so from our perspective, it's how do you do that? And, we've got our own, culture that we think is unique in that respect. But I think being more data-driven in understanding why someone wants to locate somewhere. I mean, we call it the why. Why does somebody want to locate? And most of it in the new world will come down to talent. And we think that talent is going to be critical in a lot of these and this isn't new world stuff. This is where the world was going. Why do they want to be there? Why do they want to live there? Why do they want to recreate there? Why do they want to be where they want to be? And so understanding that, and the biggest difference in this, in anything else that I've been through, and I've been through the 4 big ones, having been doing this for 42 short years, is that it's global. I mean, it's not an industry sector meltdown. It's not a region. It's not a currency. It's global. And I don't think, when we talk about black swan events, I don't think anybody's experienced a global black swan event quite like this. I mean, we are living in unprecedented times. Right. And so at the end of the day, I think that that information will be critical. Technology will be critical as it relates to all this, and understanding why the best talent wants to be where it's going to be, and it's going to be intellectual innovation that is going to be the big demand driver. And then the other big thing out of all this that 9/11 was a very emotional interruption and tragedy in our lives. It was very localized, in terms of DC and New York in particular. But and that was a call to arms, for the United States and all that. This has a sentiment aspect to it that's very, very difficult to get your full arms around. And I think that there's an element of generational perspective and maybe fear because of where this disease goes after, being a vulnerable one myself, but also just kind of how the world works. And, these kinds of things don't happen, for anything other than, we've created this mobile society, right? And this mobile society has accelerated the growth of something like this to the point where it shuts down a whole global economy. And when you're talking about the sentiment of how people feel about, how they want to conduct their work lives, whether they want to do it remotely or whether they want to be more in touch, the sentiment is vast, right? And it's not regional. It's really so much a part of someone's life that. Yeah. And by the way, it's not just about being worried about whether you're going to get it or not. It's whether you're going to be a carrier and potentially put someone in your own family or friends and colleagues at risk. So that's the one thing.
What do you think changes in a substantial way, not just around the edges, more people working from home, fine, but what are some fundamental changes where things aren't going to go back as it relates to real estate?
Yeah, I think that, if you, and we picked up with our partners in Singapore in particular, that, Asia has gone through these types of things, whether it's the bird flu or whether it's SARS or everything. So they were better prepared for this. And if you walk through an airport or, any major public area, you maybe don't see it, but there are temperature monitors and all those kinds of things. You kind of walk through it without thinking about it, and you think it's part of their and I think that is going to be one of the biggest things, which is as we saw 9/11 start to impact us in security through airports, I think you're going to see at least in the foreseeable future this what I'll call health security that's going to be enhanced, and it's going to change in terms of the number of people and frequency of public transit. I think it's going to be affect the number of people that go in and out of shopping malls, office buildings, and the like. And so I think that's going to be what I'll call health security is going to be the number one thing, and that's going to impact our real estate business. I think about how we're planning our back to work, and we have 3 of our offices back to work now, and next week we'll have 6, and they're rolling out by jurisdiction, and with the health and well-being of our people being first and foremost. But when you look at how people ultimately want to go back to work, as we look at it, there's also a cost associated with it. So whether you go back to work on these flights where you have an AB or an ABC, and you think about how frequent that is, there's on one hand, there's the gestation period for, carrying and having it and being able to test for it. But then there's the practical aspect, which is how do you do the deep clean, and how expensive is that? And is that a building owner's challenge or a tenant's challenge? And the answer is yes, it is. It's our collective challenge. That's going to be a big thing, and it's going to change the cost structure a bit, at least in the near term. And we've seen these studies, right, that look at all the pandemics all the way back to the 1900s, right, that we've been privy to. And what they basically tell you, first of all, none of them have had the economic impact that this one has had. None of them have had a major financial market economic impact. And deaths have been, significantly higher, and certainly higher by proportion because of, the relative. Enough, within 12 to 18 months, things went back to normal.
Right.
And so you can't assume that's going to happen. So you have to plan that they won't go back to normal. But at least history has suggested that people don't forget, but they modify their behavior to what they think is an acceptable way of life.
That happens to be my belief. My belief is, I remember conversations after 9/11 about all topics like, will people want to be in high rises? Will anyone want to live in New York? We will all be hunkering down in remote locations, in underground bunkers. And I think that this too will go back to a new normal. It's going to be new. It's not going to be the same, but it's probably going to be more like the old normal than not in many ways. Although I agree 100% that health safety, just like security safety, is going to be a big piece of our lives for a long time. But
and there is still stigma, associated with tall buildings in certain locations, right? By tenants, and it's interesting because it doesn't take more than one in this day and age to change people's perception of all that. But that's probably the question that we get asked the most, which is, what does, in the office space in particular, what does that kind of look like going forward? And what we've tried to do is get to the best source if we can, and that's the top interior architects that are designing space currently for the people who are most likely to take the space, which is, the new new technology, if you will, or technology, if you will. Interestingly enough, though, and what they'll tell you is that there's two different schools of thought. One is we want more space with fewer people. The other is we need less space because we're going to have more people working from home. Isn't it interesting, though, that if you're Google, Amazon, Facebook, Microsoft, that you've had this ability to be remote for 25, 30 years, right? People still believe that the collaboration has to be there. So,
and humans are social animals. They want to be together. No, I agree.
Some people think I'm just an animal, not a social animal.
You're both. Another question I'm sure people ask you a lot is, okay, Roy, the market or sees the fog of the battle is still thick. Maybe it's lifting, but it ain't done. So I got a bunch of dry powder. Where, when, what should I be planning to buy? At what price? What is your outlook 3, 6, 12, 18 months out?
Well, it is, a question, the answer to which is it depends. And it depends on one's relative risk profile, kind of what one's investment strategy is. You see a lot of capital being raised right now for distressed debt opportunities and distress in general. That's being raised, and there are, sponsors that are putting money into that with hopefully capable investment advisors and plan sponsors to be able to face that challenge. So with that, I still think it's a little early, even for distress, other than these fast liquidity options around what we saw in the mortgage REIT space, but even that's stabilizing at this point. There's going to be defaults in CMBS land as a result of the inability to be able to pay rent by tenants, and tenants being and landlords being able to pay the mortgage payments. So I think there's going to be defaults in that. So on the opportunistic side, that's where that money's supposed to go. And candidly, they were having more and more challenges being able to find opportunities as pricing was getting richer and richer,
Right.
where supply and demand was imbalance, and people hadn't over-levered and all that. So my view is that's going to be available, but it's not available yet. And I think people are waiting and watching to see how much more aid the U.S. government's going to provide in terms of forbearance and or liquidity before they kind of, cry uncle. And so this bid-ask spread, which is certainly out there, it's going to take a bit to see what the next shoe to drop is, and whether that's on the demand side because people just decide that they're going to wait it out for the summer, or if it's that the liquidity has gotten as far as it's going to go. And don't forget, we have an election year coming up here, or we're in it, and it's clearly there's political winds blowing both ways. So I think that on that side it's going to be there. I think on the what I'll call the regular way or core plus business, if you will, where people are looking to try to get a fair risk adjusted return, you still have that, and you're faced with it, what I call the CIO conundrum, right? Which is, how do I get the returns that are required actuarially to pay out my recipients, our beneficiaries and constituents? And the bottom line is that's not changing, and it feels like it's going to be lower for longer. So what is the safest thing I can invest in to get me to continue to think that it's real estate? And again, it's likely to go into some of these areas that I described earlier. And I think that I don't think pricing is going to change much. I think that what will happen is that people will be there'll be more negotiated deals than there will be auction. And I think that's the primary difference.
And that makes a lot of sense to me. I happen to agree. So let's play it forward a bit and kind of imagine that environment. There's a lot of money parked on the sides. There's a much more informed capital markets, both lenders, the government and their play, lenders and investors. By and large, there's less leverage in the system. Assets are less leveraged. Even if values do decline, it's still not going to be, perhaps nearly as leveraged as they were in the 90s or even in the O's. So do you think that there will be, on a massive scale, a price capitulation given this supply dynamic and information environment? I think
that the big price capitulation is going to be in my view in retail, and ultimately hospitality will come back from a demand perspective. Come back in waves. It's likely to come back in drive-to resorts, limited service, full service, kind of in that order, and then we'll ultimately get back to group houses and big box stuff. So that's one where there's an opportunity to get an outsized return for the relative risk, is in relief capital and hospitality, whereas retail, you've got to really make a structural bet, right? And I think that there's going to be kind of a redistribution of wealth, if you will, and all that, and literally a redistribution with these major tenants and their control over the malls and the malls' control over them. That's going to get mitigated. I think that when you look at, so I don't think that that's a big enough segment of the market that it's going to get filled with all that capital. And it's going to have to get filled, kind of in the corporate world, and less so, I think, in real estate. There are, if you look at the sell-off of REIT prices for office building REITs in New York City, Wow, that's a short bet right now. I mean, people just believe that New York City is the epicenter. I think it's oversold completely
Agreed.
in that regard, and I think that people are going to make a lot of money in that, but you know, but not because they thought they were going to go in and buy something at a steep discount to get that kind of return. It's because they're going to be in a core plus bucket that just understands the space. And then the rest of it, and it comes down to, you know, what does that core plus capital need to achieve? And I think it's going to migrate into multifamily, industrial, the data centers, either directly or indirectly through public markets, and life science and core office in innovation markets.
It seems to me, if I translate what you're saying the right way, a few observations here, just kind of summarizing. I'd like to make sure that I got it so you can confirm. One, there may be a lot of frustrated rescue capital or distressed capital. It's not going to get placed because they're going to wait too long. And two, which relates to that, the windows of opportunities may be short, and they may, and the price dislocation may not be nearly as deep as people would like to believe, or at least people would like to experience.
Right.
And third, that there's probably not a whole lot of spoils left for those who are waiting for the proof to be in the pudding. You're going to have to make a leap of faith and underwrite returns that probably are a little bit uncomfortable given where we are in order to win a bid. But those who do will probably do quite well.
Now, see, it took me a lot longer to say that than it did you. That's why you are who you are.
Well, there you go.
But I think that's fair, and I do think that it's no longer a momentum game, right? No longer trying to fit things into the same return requirement that shouldn't be in. I think there's going to be a distinct difference between winners and losers, even within some of those submarkets that I've talked about.
Yeah.
I mean, retail, for example, if you've got drug and grocery anchored open air malls, I would suggest that that's been way oversold with the rest of retail, and there's probably some huge opportunity in there. I think you've got to be smarter about this, and it's been a little too easy.
Well, if you have any portfolios with grocery and drugstores that are available, we'd like to know about them.
Okay, well, listen, should we cut it off here and I'll just get on the phone with you?
Absolutely. Well, give me 2 minutes to wrap it up. It's always a pleasure to talk to you, and I do want to invite you back maybe in a few weeks to see how things develop and how your point of view changes. But I do want to ask you a few questions as we wrap it up. One, what surprised you in the last month or two, period?
Yeah. I think what surprised me was how easy it was to adapt to, work from home. And I think that most of the people you talk to, whether they, after an extended period of time, whether they or their families like that, the fact of the matter is that it was a pretty easy transition to be able to do it. Now, is it as productive? I would argue absolutely unequivocally not. It's a fraction of productivity. And as good as this medium is, it's just a fraction of productivity from our perspective, at least. Having said that, I think that there are aspects of this that we will be able to use these tools more productively going forward, as in addition to what we do. But that surprised me the most is how easy this was. And I give all the credit in the world to our technology and ops team.
They're the unsung heroes. Good, Good for you. What about in the business, in your business, what surprised you? Or in the real estate capital markets transaction activity, what surprised you there?
Well, it didn't surprise me at all that things came to a screeching halt, because we'd lived through the GFC. No matter how you look at it, the financial markets have created most of the great recessions. And if you look at the late 90s, we actually were paramount to all that. We were the cause. This is the first time that real estate that I can remember in all of them, or the financial markets, haven't contributed to significantly or created a major recession, if you will. So I think that, from my perspective, it didn't surprise me that things came to a screeching halt. And I guess having been through it before, while this is unprecedented, all the rules and the things you do to shut down the system, to make sure that the body and everything else is working properly to be able to assist others. All those instincts just kicked right in, from all of our seasoned team. And what it reinforced was also culture. And that's the other thing that I suggest around, people's, social distancing and or stay at home versus, returning to work. I think it's impossible to build a culture, remotely, if culture is an important part of what you do. And so I was pleasantly surprised also about that, is that our culture really, really made a difference.
What do you think is going to catch people by surprise over the next month or two?
The financing market returning faster than they expected to. The thing that concerns me most is what I'll call the social impact of all this. You're beginning to see, and I don't know if it's just that, we as a global society have a short attention span, and our ability to be able to quarantine for an extended period of time gets tested, and as it gets tested, we get testy. And what will be interesting to see is if this continues on, and there are some who are suggesting that it might continue on in terms of stay-at-home orders and the like. I think there's going to be some social unrest that comes along with that. And if you recall, I at the end of every one of our capital markets presentations, I've told people that as great as it is, trees do not grow to the sky. And it's likely to be something that's unexpected. So don't be complacent. And an orange swan event, which is obvious. We could, talk about our orange swan in the White House, or ultimately now a green swan event. And that green swan event is kind of what jurisdictions, whether it's city, state, local, kind of their imposition, whether it's regulatory or through taxes, head taxes and things like that, or in one never would have expected this, less of a democratic application, if you will, of those powers, and watching how state, county, city, jurisdictions fighting it out with the federal government. That's going to be very interesting. I pray that we don't get there, but that's one of the things that concerns me, is that lingering distrust. And I think that if you look at the reason why we were least prepared and least prepared as a society is we've lost trust in so many ways. We didn't trust the Chinese in terms of reporting what they had. We didn't trust our own government, that we were serving up accurate information. There's been a loss of trust, and we need to get that back in order for us to be a society that we can be proud of.
It'll be nice to get it back. We have been the whole globe has been on a slow but persistent transition into more of a nationalism, protectionism, more inward-looking, preservation, protection, call it what you will.
Self-reliance, yeah.
And it seems like maybe what you're talking about is that over the next, in our future, there is maybe an acceleration of that pattern in America, and whatever that means may not mean all that. May not mean all good things, right? It can not all be good. So, on that note, we'll part. Roy, always a pleasure talking to you. There's so many other things we could talk about. We could talk about charity and fixing the world and all the great things you do. We can talk about the travel and when you plan to travel and where you plan to travel. So why don't we hold those topics for our next conversation? And in the meantime, stay healthy, be well,
Yeah.
and the best to you, your family, and your colleagues.
You too. And by the next time that we talk, I will be in a different location. I can guarantee you that. Take good care. And thank you. Thank you so much.
Thank you, Roy. Take good care.